Welcome back, everybody. Today we're talking about Caterpillar, a global leader in heavy machinery and just about anything you need to do construction, mining, and in general, build infrastructure. And as much as the US government and just about any government loves to spend money and build infrastructure, Caterpillar should be crushing it, right? Well, according to their stock performance, yes, because Caterpillar's handily outperformed the S&P 500 over the past 5, 10, 20, and 30 years in terms of total return. So is Caterpillar stock a buy right now? Let's find out. But before we dig into their business, let's take a look at some basics for Caterpillar stock. So if we go to Seeking Alpha, we see that Caterpillar is trading at $247.36 a share. Over the last 12 months, they're up a little bit over 4%. In year to date, they are up 3.5%. In terms of dividends, they pay a rate of $5.20 per share, which equals a 2.11% dividend yield. Now, if we look at their dividend summary, we see their dividend yield right there of 2.11%. They have a payout ratio of 25.20%, a 5-year dividend growth rate of 8.80%, and consecutive years of dividend growth at 30 years, which means that they're a dividend aristocrat. And if we take a look at their dividend growth in more detail, you see that their 3-year dividend growth is 6.67%, but in the 5-year and 10-year, it's both over 8%. So overall, the dividend growth has been pretty good and in line with their 5-year averages, but it looks to be declining a bit in terms of growth rate. But part of that declining growth rate has to do with 2020, where they basically paused raising the dividend and then started back up again in 2021. They still got credit for the year because the full year of 2020 was higher than the full year of 2019. But if you look at the last 3 dividend raises, they were at 7.7% in 2021, 8.1% in 2022, and then 8.3% in 2023. So they're back over 8%, and that dividend growth is increasing over the past 3 that they've made. And then real quick, if we look at the momentum tab, we see that in terms of total return versus the S&P 500, that Caterpillar has really outpaced the S&P 500 on every single timeline, whether that's the 5, 10, 20, and 30. All right, so we have an idea of what the stock is doing and how it's performed, but let's talk a little bit about their business. Because Caterpillar manufactures and sells construction and mining equipment, off-highway diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives in the United States and internationally, along with providing support and financial services related to their product offerings. In terms of mission and strategy, Caterpillar has a goal of profitable growth that they aim to achieve by focusing in 4 areas: services, expanded offerings, operational excellence, and sustainability. Additionally, Caterpillar stresses adherence to their 5 core values, which are integrity, excellence, teamwork, commitment, and again, sustainability. So how does Caterpillar actually make money? Well, their revenues are broken down into the following 4 categories: construction industries, which is basically the sales and support for clients in infrastructure, forestry, and building construction. And this accounted for $25.3 billion in 2022, which was 40% of their revenues. Resource industries, which is sales and support for clients in mining, heavy construction, and quarry and aggregates. And this accounted for $12.3 billion in 2022, which was 19% of their revenues. Energy and transportation, which is sales and support for clients in oil and gas, power generation, marine, rail, and industrial. And this accounted for $23.8 billion in 2022, which was 37% of their revenues. And then lastly, financial products, which are financing services for Caterpillar products, and this accounted for $2.8 billion of revenue in 2022, which was about 4%. And then additionally, the growth rates for these particular segments between 2021 and 2022 were as follows. Construction industries grew at 14%, resource industries 26%, energy and transportation, 17%, and then financial products, 3%. Now, if we take a look at their revenue growth in Seeking Alpha, we see that year over year, Caterpillar's revenue growth has been over 17%, which well outpaces their 5-year average of 5.66%. Now, their projected revenue growth is 10%, which is a little bit lower, but still quite a bit higher than their 5-year averages. Now, one thing to consider with Caterpillar is their revenues are going to be cyclical. That means that they're going to ebb and flow with economic and investment cycles and infrastructure, and they're obviously going to be impacted by global and political events due to the nature of their work. And if we take a look at their financials, we can see the ups and downs in their revenue in more detail. Over the past 10 years, if you include the trailing 12 months, they've had about 5 years of growth and 4 years of decline, and basically 1 year that was flat. And over that time span, their compound annual growth rate has only been 1.81%. But if you look at just the last 7 years, including their trailing 12 months, their revenue compound annual growth rate is 8.1%. And while the revenues do fluctuate over time, the fact that they're a dividend aristocrat shows that they've been able to manage that and still maintain consistently growing dividends to reward their shareholders. And while revenues may be cyclical, Caterpillar's business is pretty diverse in terms of geography and industry as it relates to heavy machinery. North America makes up less than 50% of their total revenues, with the rest spread out between the other 3 major geographic regions. Because they have products and services across construction, mining, and energy, they have opportunities for growth in multiple areas, depending on where the infrastructure spending is happening in each geographic region and even in each specific country. Okay, so now that we have an idea of who they are and what they do, let's talk about risks. Risk number 1, global economic and political conditions could severely impact their business outlook. And one of the strengths of Caterpillar's business is that it's global with diverse business segments. And this allows them to be part of infrastructure investment and development all over the world in different development life cycles based on the region. But this also means that they have to deal with the unique economic and political challenges of each region. This adds a lot of complexity to their business and ability to meaningfully plan over the long term. Plus, rising global political tensions and conflicts could exacerbate that issue, are unpredictable, and tend to happen very suddenly. Risk number 2. Impacts to commodity, material, and labor pricing and supply could severely impact their business outlook. Now, commodity and supply chain prices impact Caterpillar's business in multiple ways. First, they are a significant user of commodities like steel and other raw materials in the development of their products. So rising costs or difficulty in the supply chain could impact their ability to deliver on their current demand, as well as continue increasing their margins. Also, changes in commodity pricing could impact viability for certain projects or investments by clients in areas like mining. For example, if the price of a commodity being mined is below the threshold needed to make the investment profitable, those projects could be canceled or at best postponed, which would obviously impact Caterpillar's business. And lastly, shortages or price increases in the labor market could make it difficult for Caterpillar to staff their services appropriately, causing material impact to their overall service provided to their current and prospective customers. Risk number 3. Changes in government, monetary, or fiscal policies may negatively impact their business outlook. Now, while this is related to the first risk, I think it deserves its own section due to the current state of the global economy and interest rate outlook. If there are higher for longer interest rates in the U.S. or similar actions to slow down economic activity in other countries, demand for Caterpillar's products and services would likely decline. As governments and corporations try to reduce spending in light of lower demand or to pay down debt that will need to be refinanced at higher rates, investment into new infrastructure or construction could be materially impacted. And obviously, the cyclical nature of government policies and economic behavior show up in Caterpillar's business model or revenues already. But this is a risk worth calling out due to the fact that the U.S. and many countries are in a situation where some are predicting slower economic activity going forward. And part of the challenge with this is that it's really hard to predict because obviously governments want to spend money, and there's already been a couple infrastructure bills that have been passed that Caterpillar has already said that they think will add to a favorable 2024. But there's also an election in the U.S. next year, and Moody's just lowered their outlook on the credit rating to negative. And honestly, there's not that much hope in sight of our political leaders actually being adults and doing what needs to be done. So while I do view this as a significant risk, that's part of the advantage of their global business. As certain areas of the world are contracting, others hopefully should be expanding. And ultimately, it seems that every government is trying to do more and spend more, which likely bodes well for Caterpillar, regardless of if I think it's the right thing or not. So now that we have a good idea of the pros and cons of their business, let's take a look at how they've been performing operationally. So Caterpillar's free cash flow generation was in a downtrend from 2013 to 2016, but they've had free cash flow growth in 6 of the last 7 years, with the one exception being the 2020 pandemic year. Now, overall, they've had a modest 4.21% compound annual growth rate over the last 10 years, but it's an 18% compound annual growth rate over the past 7 years if you include the trailing 12 months. And Caterpillar's been aggressively buying back shares with their free cash flow since 2018, as well as continuing to pay and grow their dividend. So let's take a look at their debt situation. Caterpillar has a total debt position of $37.1 billion, with $8.4 billion of it being long-term debt. They also happen to have $8.4 billion in cash and short-term investments, which gives them a net debt position of $28.7 billion. Now, Caterpillar's interest expense is about $500 million a year, which is pretty easily handled by their $8 to $13 billion a year of operating income. So even with over $28 billion in debt, which I would consider to be a lot, I still think it's relatively healthy based on the amount of income that they're generating. So obviously, if there's any slowdown in that income, or if they have to refinance their debt at much higher rates to where their interest expense goes up a lot, then at that point, maybe the debt becomes a bigger issue. So if we look at their profitability, in terms of margins, Caterpillars across the board are outpacing their sector medians and their own 5-year averages. Now, while their gross profit margin is exactly the same as the sector median, which is kind of random and weird, their net income and free cash flow margins are greatly outpacing their sector and, again, above their own 5-year averages. An adjusted operating profit is something that Caterpillar concentrates on and reports on each quarter, as they try to optimize price and volume growth versus manufacturing cost increases. And just real quick, if you guys enjoy these type of breakdowns, my stock analysis library continues to build. I post analysis documents on even more companies there, as well as additional content and member-only videos. For more info, check out the link in the description. Okay, so we have a decent idea what's happening in their business. Let's look at their valuation. So if we take a look at the data that's been pulled in, we see that they have an adjusted price to free cash flow of a little over 14 and a cash flow yield of just under 7%, which I would consider to be really good. We see their dividend growth metrics here. In terms of years of dividend increase, we already know it's 30. Their dilution trend is down. Their moat is wide according to Morningstar, and in terms of have they ever outperformed the S&P 500, we already know the answer is yes. So if we take a look at their discounted cash flow model, after adding our cash from operations, our CapEx, and our stock-based comp, we get a fair value price per share of $181.24. Now that's quite a bit below the $247 it's trading at right now, so let's take a look at our assumptions. So in terms of starting cash flow, I decided to use the average instead of the trailing 12 months, even though obviously the trailing 12 months is much higher. And it's just because there is a little bit of variability in their numbers. And if you look at these past years, they really were much lower than the trailing 12 months. And so again, I'm just being conservative in my assumptions. In terms of starting growth rate, I'm using 11%. Even though the calculated growth rate on the sheet was 18%, I didn't want to use that high of a number. So I went to Seek Alpha and I saw that the operating cash flow growth is projected to be 13%. And, that seems kind of high. At least it seems pretty aggressive. The revenue growth was going to be 10. So I really just kind of split the difference and just used 11. Now, obviously, I've talked about it many times. A lot of these things are more art than science, especially when you get into the assumptions that you put into your DCF model. So regardless of how aggressive or conservative you are with the DCF model, it's probably going to come out as lower than the current price. And part of that, I think, is a premium that you pay for a company like Caterpillar that has a wide moat and a really strong history of dividend growth. But let's take a look at the multiples models and see what they tell us. So if we take a look at the multiples model, the peers that we're using are Deere & Company, Illinois Tool Works, PACCAR Inc., and Cummins Inc. And as it relates to price to cash flow, we get a fair value price per share of $355.40. Now, this is quite a bit above where the stock is trading at today. So obviously, the reason for this, as you can see, is Caterpillar has the lowest price to cash flow out of all the companies in the peer group. So obviously, that's going to push that fair value price up. And in this case, it pushed it up quite a bit. And now if we look at the multiples model for price to earnings, we get a fair value price per share of $256.98. Now that's above the current price, but still higher than our target price, which uses a 20% margin of safety. All right, so if we look at all the valuation methods together, we see that the analyst mean price is $265.05, which all of these are a little bit all over the place, but it's closest to our price to earnings multiple valuation, where our DCF model is quite a bit below and our price to cash flow multiples model is quite a bit above. So now let's take a look at historical price metrics. Looking at historical price to cash flow and price to earnings multiples, Caterpillar is currently trading at a price to cash flow of under 11 and price to earnings of under 14. And if we look at the past 10 years, Caterpillar is trading at levels that look pretty attractive, especially as it relates to price to cash flow. Because the last time the price to cash flow got down to those levels was during the 2020 pandemic. And if you want to exclude that as an anomaly, you'd have to go back to 2017 as the last time that those happened. So even though the last 10 years have been a zero interest rate environment, I would still consider their price metrics to be attractive based on recent history. And if you really want to look at potential worst case scenarios, we can go back to the last major recession time in 2008, and we see that it was trading around a price to cash flow of 4 and a price to earnings of 6 in November of 2008. Now, is that a realistic possibility that we need to prepare for? I mean, I really don't know, but I do think it's helpful to look outside of the last 10 and 15 years wherever we can. All right, so let's rate Caterpillar using the 3 criteria I use to evaluate stocks: business, operational performance, and valuation. So from a business perspective, Caterpillar has a wide moat and diverse overall business in terms of geography and industry that they support. Their revenues are cyclical, but they're a global business that's able to take advantage of opportunities all across the globe as different regions and countries go through different economic cycles. Lastly, those global opportunities also come with increased complexity in their business, as there are different political, economic, and cultural issues that they have to deal with. But still, overall from a business perspective, I would rate them as good. In terms of operational performance, Caterpillar has had strong free cash flow generation, especially over the past 7 years, where the compound annual growth rate has been 18%. They're a dividend aristocrat with dividend growth greater than 8% over the past 5 and 10 years, as well as their last 2 dividend raises. And they have increasing margins that outpace their sector. So from an operational performance perspective, I would rate them as good. Lastly, in terms of valuation, the DCF model is about 70 to 75% of the current price, but with their PE at 14 and especially price to cash flow at 11, those look attractive based on the most recent history of the last 10 years or so. So from a valuation standpoint, I would rate them as okay. So would I rate Caterpillar as a buy? So for me, Caterpillar is a buy, and I've actually already added it to my portfolio as of last week. I published my analysis document on Caterpillar on November 13th, and I started with just a small 2-share addition on November 21st. But then I took a bigger position on November 22nd, buying 37 shares of CAT after I trimmed one of my other positions. And obviously, we'll talk more about all that in my portfolio recap for November, which will be next week. But here's what I liked about Caterpillar and what made me want to buy it. They had strong revenue and free cash flow growth over the past 7 years. They have a wide moat business with geographic and industry diversity. So if construction investment is down, there's still mining. If mining investment is down, there's still power generation. If power generation is down, there's still oil and gas or marine or rail and industrial. And then if those things are down in North America, maybe they're picking up in somewhere else in the world. You get the picture. They have margins that are increasing, and their dividend growth is greater than 8% with a strong history. In terms of valuation, I actually think they've come down to a pretty attractive level as well. And obviously, if you caught them at 226 at the end of October, that would have been ideal. And for me, I didn't catch them at that level because I wasn't done with my analysis in time to know if I should buy. And I just waited until I actually finished my analysis to know if it was a good fit for my portfolio, which ultimately I thought that it was. In terms of the things about Caterpillar that I'm not really a huge fan of, obviously their revenues are cyclical, so that presents a risk seeing as they've had a really good run over the past 7 years or so. And there's a risk of reduced government or corporate investment in infrastructure, even though there have been multiple bills passed that should ramp up spending. But the U.S. is going to have some issues to deal with from a fiscal policy perspective, and I'm assuming that's going to happen sooner than later. And that could reduce overall spend. Plus, in general, with rising political and economic uncertainty across the globe, that just presents an overall risk to Caterpillar's business that's hard to project. And lastly, obviously with their debt, even though I think it's relatively healthy, it could become an issue if revenues stall or if interest expense meaningfully increases with higher refinance rates. But overall, Caterpillar was one that I was actually really excited about after digging into it. And for me personally, it fits really well with the rest of my stuff in my portfolio because it's quite a bit different. Because right now I have a lot of holdings on the consumer spending end of the spectrum. McDonald's, Starbucks, Walmart, Hershey, even Apple could be put into that group. And I've wanted to add something on the industrial side or non-consumer product side for a while, especially after I sold Waste Management earlier in the year. So Caterpillar is a nice complement to the rest of my portfolio, and I think it'll be a really nice addition. But as always, only time will tell, and we'll see. So what do you guys think about Caterpillar? Are you already holding it in your portfolio? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.